This time, it's very slow. They're saying, no, it's okay, work with borrowers. That does not mean that a bottom won't be found. A bottom will be found, and it will be a deep bottom. Maybe not as deep as the global financial crisis, but it will be deep. But we will reach it in a much slower way than we did during the global financial crisis.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 405. There's trouble on the horizon for commercial real estate. Some of that trouble is coming from the office sector, and some of it is a result of interest rates more than doubling from this time last year. So what kind of distress are we seeing in the commercial real estate market? And how can we understand it better so that we can perhaps acquire properties at a discount? My guest today believes a period of wealth transfer in commercial real estate is upon us, bringing exceptional investment opportunities to both sponsors looking to buy discounted deals and to individual accredited investors who want to invest in these opportunities. Dr. Adam Gower is a 30-plus year real estate veteran with over $1.5 billion in commercial real estate investments, who has taught over 4,800 people on how to build wealth, preserve capital, and earn passive income from investing in real estate. Adam, welcome back to the show.
Hey, thanks for having me, Brian. It's nice to be back.
Tell our listeners a little bit about you and what your niche is in the real estate investing world.
Sure. So our primary focus, the way that I earn my weekly envelope, is by building what are colloquially called crowdfunding platforms for sponsors. So we build websites and digital marketing systems so that sponsors can find accredited investors to invest with them. And we also teach accredited investors on what to look for out in the market. Now, what we've noticed, and our clients actually manage in excess of 35 billion in assets under management, AUM, about 35 billion. They've raised over $1 billion from accredited investors in syndications using our systems. And so we have a really deep insight into what's going on in the market because we deal with so many sponsors, many of them, some of the top sponsors in the country, some of the biggest syndicators in the country or the most successful ones. And so we really have a sense for what is going on. And you cannot underplay the impact of or understate the impact of rising interest rates over the last now 18 months or so. It is having a very significant impact on deals that were put in place particularly over the last 3 years or 3 or 4 years. And there is a lag in the impact of those interest rate hikes that is going to impact the market over the next 6 to 18 months, depends on who you talk to. But over the next 6 to 18 months, in other words, by the end of this year, 23, and deep into 2024, you're going to start seeing an increasing number of commercial real estate projects that were syndicated in the last 3-4 years, 2 to 4 years, that will go under very significant financial strain, inevitably be lost to banks, and will transfer hands to a new generation of investors.
Can you kind of give us examples of what you're seeing on the ground? Like what you just said, that's kind of my perception of what's happening in the industry. But can you give us some specific examples of projects or investments that you're seeing that are in that danger zone?
So there really are no asset classes that are immune. There's this nice idea that perhaps multifamily is different, right? But it really isn't. I mean, the impact is industry-wide. quite apart from interest rates going up as fast as they have, that of course have immediate impact on the bottom line, you also have a considerable increase in the cost of capital expenditure. So any kind of improvements that were planned or that are ongoing at a project, those are going to cost significantly more. And then another impact is insurance. Insurance has gone up multiples of what it was 2-3 years ago. So all of these factors are impacting net operating income. The other thing that is inevitable, I tell you something, Brian, I got into a little bit of fun was poked at me on Twitter. I quoted somebody that I'd been speaking to on Twitter, and I said, interest rates go up, cap rates go up, values come down. I quoted him. And he wrote back to me and he said, oh, nice, rocket science. As though that were somehow so ridiculously obvious that if interest rates go up, cap rates go up and values come down, that somehow that was so ridiculously obvious that it goes without saying. But when I wrote that post, probably 6-7 months ago, there was considerable debate about whether or not interest rates would drive cap rates in the same direction and inevitably push values down. Today, it looks blindingly obvious. It's so obvious it goes without saying. Actually, there's a Japanese term for that. It's called atarimae. You can't actually, there's no equivalent in English, but occasionally it's useful to use other languages. Anyway, so the question today is, what is so blindingly obvious today, or what would be so blindingly obvious in 6 months that it's ridiculous to even imagine it is anything other than obvious today? And one of those things is the inevitability of a slowdown in the economy. It's not, and the impact that is going to have on commercial real estate as well. So it's not just commercial real estate or any kind of real estate that is impacted by increasing interest rates, but there is also the corporate world has enormous amounts of debt. And as that starts to come due and impact companies, it's inevitable that they're going to have to, for the same exact reasons as it impacts real estate, they are also going to have to look for ways of cutting costs. And one way to do that is going to be employment, to reduce overhead. And you're seeing it in the tech industry already. But it's to reduce overhead, which will lead to higher unemployment, and to dial back on spending, which slows the economy down. So as the economy starts to slow down, and in 6 months, it is going to seem really obvious. And by the way, I'm actually researching this at the moment, the idea of a recession. So I might be wrong. It has been known, I like to say. But a recession is defined as a significant, and there are all kinds of definitions of recession. But in principle, a recession is 2 consecutive quarters of significant decline in output, right? Relative to the prior quarter. Well, if the decline is slow, and I'm drawing my hand across the screen for those listening and not watching, in a flat line, right, or a shallow sloping line, then each quarter, the change is not significantly different from the quarter before. If you look back on where we are at any point in time, you go back 2 quarters, 3 quarters, 4 quarters, 8 quarters, you can see a significant drop. But if the change quarter to quarter is gradual, does that measure a recession? Does that mean we're in a recession? Well, it may not be defined that way because the change is only slight. Now, what the Feds are doing, increasing interest rates, is putting an extremely hard brake on the economy. But what regulators are doing in banking is they are encouraging banks to work with borrowers. And so what regulators are doing is they are asking borrowers, they are slowing the rate of decline so that it is a measured, slow decline rather than a precipitous one, which is like the one that we had during the global financial crisis. I can see you intaking breath, wanting to say something. Go ahead.
I'm wondering then, are you saying that the lenders and the banks are kind of easing us into that decline by not going into foreclosure, or they don't want to cause too much turbulence in the commercial real estate assets that they have loans on right now? So they're kind of working with the borrowers to either hold off or prevent that sort of disaster from occurring?
Yes, it is a slow decline. It's not a precipitous one, unlike during the global financial crisis, right? So 2008 plus for a few years, when banks were mandated to what's called mark to market their assets. When they were told to mark to market, they had to reassess their entire portfolios in a very short period of time to determine whether or not assets on their books, assets being loans that they put out, were underwater. Were they worth as much as they thought they were? And because regulators insisted that they did that, there was a very intense period during which banks had to mark vast amounts of their portfolios as being underwater. They had to get rid of them. So it created a fire sale, and it happened very, very quickly. We went off a cliff. It was so sudden that it seemed like there was a potential for systemic collapse, right? And it was very, very frenzied. This time, it's very slow. They're saying, no, it's okay, work with borrowers. That does not mean that a bottom won't be found. A bottom will be found, and it will be a deep bottom. Maybe not as deep as the global financial crisis, but it will be deep. But we will reach it in a much slower way than we did during the global financial crisis.
So what is your outlook then? I mean, it doesn't sound like you're a soft landing guy, because there's a lot of people thinking, well, we're going to have a soft landing and work our way back up again. You're looking at something deeper. What are your projections then? And this will come out in October. So what are your projections over the next 6, 12, 18 months? What do you see happening?
What is a soft landing exactly? A soft landing is exactly what I'm describing. Instead of a hard landing, which is something that just suddenly happens and everybody kind of slams the brakes on all at the same time. If there is a slow decline, isn't that a soft landing? That is a soft landing, but it doesn't mean that we don't land somewhere really deep.
We're still going to hit the same bottom.
Yeah, you're not going to hit it with your nose. I think of an airplane, God forbid, coming out of the sky. You're not going to hit it nose first. You're still going to land, but you're still going to hit it, right? You're just going to come in at a gradual decline. That's a soft landing. But we'll still get to those depths, especially, even just thinking about home prices. It's ridiculous the way that home prices have not yet bottomed out. That is absolutely inevitable. There's no possible way that 8% interest cannot have a profound effect on home prices when you've got against a period of time when people were buying at sub 3%. Not possible. Blindingly obvious. You can debate it today. And if I was to put that out today, as I am doing now, and listen to it in 6 months' time, people will say, you're speaking obvious. Why are you saying something so obvious? Because today it's not so obvious.
Well, okay. So a lot of people, and let me know where you fall in this. A lot of people believe, okay, the Fed is going to raise rates maybe 1 or 2 more times before the end of the year. But then by this time next year, they'll start lowering those rates again, not back to where they were, but somewhere in between where they are now and where they were. Do you believe that as well? Or do you see something even more aggressive from the Fed?
So I would not disagree with those who think the Fed will start to reduce rates or might, lift its foot off the brake a little bit within the next 12 to 18 months, perhaps even before the next election, because it will inevitably have a positive impact on the economy. And, I don't know how to connect dots between regulators and Chairman Powell and, politics, etc. In theory, they're all separate, but that's a possibility. However, it's not going to go anywhere remotely close to where it has been, to what we've become used to over the last decade of almost zero interest rates. That's just not going to happen. And so inevitably there will be a slowdown. The slowdown is inevitable. It's not going to go away. Yeah, so so yes, they may increase, but it's like a pressure cooker. At the moment, the Fed knows that to release the pressure on the economy of trying to drive inflation down, if they release it, there'd be an immediate spring back. There's still so much momentum in the economy in terms of employment and spending in general, that any kind of lightening of the pressure in terms of reducing rates again would just jack inflation back up. There's another very important point as well, Brian, that the Chairman Powell is anchoring off, and that is one of managing expectations. Just think about this. I like to think about it this way: have you ever been on a hike where somebody else has taken you on the hike? I remember, I think about this, happens all the time, right? You go on a hike somewhere, or you go on a journey, get on a boat, you go fishing somewhere, you go out somewhere. It seems like it takes forever to get there. And it's a lot shorter, the journey back. Why does it seem like it's so far that first time you try to get somewhere where you don't know where you're going? That's because psychologically, you don't know where you're going. You don't know when the end is in sight. So one of the reasons that regulators or the Fed has this rock hard determination to hit 2% inflation, it's almost arbitrary. The number is, why not 3%? Why not 0? Right? But the reason for that is because it conditions everybody. It conditions the entire economy to knowing where we're going. So we can plan, right? There's this mentality that, okay, whether you agree with it or not, you know where we're going. You can see where it is. We can all opine about it. Right? Are we there yet? Are we nearly there? Are we going to be there? If we are there, what's going to happen next? But if we didn't have a target, you wouldn't know where we were going, and it would be much scarier an environment. So this is how you maintain a soft landing, a slow decline instead of a precipitous one, by managing the market's expectations.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. What is the distress you see happening in the different sectors? I mean, starting with office, multifamily, and other commercial types of assets, what kind of distress is going to be occurring then in the next 6 to 18 months?
So, Brian, I'm so glad you asked that, because all this chit-chatting about, macroeconomics is, okay, very interesting in inverted commas. But what does it mean And what do we do? That's basically what you're asking. All right. So the way to manage what's going on, first of all, is to acknowledge that there is going to be declines in values, to understand that people will lose assets to creditors and to their banks and to their lenders, or to foreclosure, or however it happens, and that there will be a transfer of those assets to other people. The obvious industries or asset class, or the asset class is the most obvious, of course, are office. That was largely triggered by the pandemic and people starting to work from home. So that had an immediate impact. That's something that is going to take a long time to recover, particularly in some of the major metropolitan areas, San Francisco, LA, New York, Chicago. Absolute bloodshed in those markets for office. Having said that, there are other office markets that are on fire, like, Florida is on fire. We have clients in Florida that own huge millions of square feet of office that are almost 100% occupied with rising rents. So there are pockets in every asset class. Multifamily, which is has been one of the most popular, both with investors, but also with first-time professional investors, right? Not passive. But over the last 10 years or so, it's been popular with passive investors, but also with first-time entrants of professionals, right? People that do this for a living. That is inevitably going to suffer a significant pain. And what we're seeing is distribution stopping in many cases, really fairly widespread. Distributions are stopping to investors, and capital calls are beginning to be engineered and pushed out to those investors. And this creates a lot of confusion and turmoil, really, because on the one hand, you've got sponsors who have never anticipated needing a capital call. So how do we do that? Right? What's the best way of doing that? And that is a whole quagmire of interests and alignments, right, embedded in that. In fact, it's something, I don't know, it's, we're at the end of August talking today. Sorry to date stamp this, but we're in the process of putting together some high-level analytics on how to structure a capital call and how to understand it and evaluate it from the investor side. And inevitably, we're starting to see those capital calls. And then we're also starting to see borrowers slowly losing assets to their lenders. So, you've got some very big examples coming out of Texas, some huge portfolios that have, been lost to the banks. And we are under the surface beginning to see smaller deals also beginning to struggle significantly with the inevitability that they will also return to lenders.
What are the factors then that are leading to having to return the property to the bank in this distress? Is it the fact that they have interest-only type loans, or their loans are coming due and the value isn't there anymore? I mean, what are some of the leading factors that are leading to this distress?
So the primary factor is a failure to underwrite to returns that appropriately measure risk being taken on. So I'll give you an example, specifically what I mean by that. One of the trends that we've seen over the last few years is a merger or a coincidence between the kinds of returns, cap rates, that investors have been paying for in secondary markets that are the same as in primary markets. So simply stated, what that means is that investors, novice investors, have seen returns in major cities, right, with huge employment bases, underhoused, and enormous variety of population, huge populations, where you've seen cap rates in the, say, call it 3% range, have underwritten assets in secondary markets to the same 3%. So you've seen prices being paid for assets outside of major markets where they are justified, in secondary markets where you simply cannot justify those. Investors have thought that it's a good idea to invest in a secondary market at a 3 cap because, in principle, why can't the same happen here as in a primary market. But the fact is, those are far higher risk markets, and investors have gone into them failing to underwrite to the true risk of those markets. So the first thing that we're beginning to see is failures in secondary and tertiary markets, where buyers or owners are losing assets because the fundamentals simply are not what they had thought they were. When the tide goes up, all you needed were, a lot of people were relying on cap rate compression to deliver returns to investors. That's a fundamental failure for investors over the last 10 years or so. That is going to be in its entirety flushed out of the system, right? Those values are going to collapse from what they paid, and new buyers will come in and buy them, measuring risk appropriately.
And so, Adam, how would our listeners or accredited investors, sophisticated investors find opportunity then, given all the distress that's out there right now?
So there's a few ways to do that. If you don't mind, can I plug a little bit?
Absolutely. Go ahead.
So I told you right at the beginning that what we do is we build digital marketing systems for real estate sponsors so they can raise capital online and find accredited investors. And so consequently, we have a network here at Gower Crowd of thousands of sponsors. Well, some of those are struggling, there's no doubt, but there are a lot of very strong sponsors who are being very, very patient. And by the way, that is the key word for right now, patience. Don't rush. Don't be frustrated. It's really, really tempting to jump in right now and get stuck in and buy something, and don't. Just hold off unless it's an absolute cert. So patience is key. So amongst our network, we are beginning to see opportunities from seasoned multi-cycle sponsors who are looking at the market and who are digging up really good distressed opportunities. Actually, what I should say is they're not finding those yet, but they are looking. And when they do, we will bring those opportunities to our network of investors. So that's a good starting point. Another way to go about it, of course, is to contact banks and to ask to speak to special asset managers, right? Special assets being a euphemism for distressed, right? Underperforming, non-performing loans. So special asset managers, those are good people to talk to. Receivers, good people to get to know as well, because they take, they're at the sharp edge of it. Attorneys, real estate attorneys who are working on distressed deals or whose clients might be distressed. So these are all good sources for finding distressed assets.
What is your favorite hack or app?
So it's no longer called Twitter. It's called X, for crying out loud. But anyway, Twitter. It actually has a feature that allows you to build lists. And so you can identify sources. What I do is I identify news sources. I put them all into a list, all of the commercial real estate news sources that I like, and I put them into a CRE updates list. Actually, I think you can follow it on my Twitter account, is Gower, I think at Gower Crowd. And what that allows you to do is to look at one feed that is highly tailored, just super tailored on exactly what you're looking for. So I go in there to see what's going on in commercial real estate. I don't have to scan through tons of stuff that's not relevant. It's all there in one place. I actually find that a really fast way to just get a quick update on what's going on in the market is by looking at lists in Twitter.
And also, I would have to say I'm on your mailing list. So you put out a lot of great content and links to articles that are very interesting and timely in the market. Tell our listeners how they would find out more about you or get on your list or get a hold of you.
Thanks, Brian. So go to gowercrowd.com, GOWER, gowercrowd.com, and just subscribe. There's a big red button there. It's totally free. And as you mentioned, we put out a newsletter every Wednesday. I try to get it out at 10 a.m. in the morning, but sometimes I miss that. But it does include just a list of all the articles that we see that are relevant to commercial real estate. Opportunistic investors is what we're trying to focus on. And yeah, it's detailed and there's a lot of information. You can scan through and go straight to articles that you might find of interest. Nice snapshot each week.
Yeah, fantastic. So, Dr. Gower, thanks for coming on the show and sharing your economic outlook. Some of the things that will seem obvious in 6 to 12 months that you're kind of talking about right now. And then describing where the distress is in commercial real estate, why it's there, and how our listeners might find opportunity in that distress. Really appreciated having this conversation with you. Thanks so much.
Thanks for having me. It's been a pleasure.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.